All right, let's get right into it. You've seen the headlines, right? Every single one is screaming that tourism is back with a vengeance. Hotels are packed, revenues are climbing. It really looks like a golden age for hospitality. But today, we're going to pull back the curtain and show you why that's a dangerous illusion. Because the numbers that truly matter aren't at the front desk. They're buried deep in the balance sheets. So let's just ask the big question right up front. What if this entire story, this whole narrative of a healthy, rebounding hotel sector, what if it's a total mirage, a fantasy built on shaky financial ground that's just about to crack?
You know the story you're being told. It's all about what's happening at the front desk. We see sky-high occupancy rates. We see some really impressive growth in revenue per available room, or RevPAR. It's a simple, feel-good picture of a sector that's been completely reborn. But here is the absolute key. Those are vanity metrics. Yeah, they make for great headlines, but they don't tell you a thing about a company's actual health. The real story, the one that predicts who survives and who goes under, that's not happening at check-in. It's hidden away in the financial statements.
So check this out. Here are the two realities, side by side. On the left, you've got the mirage that everyone sees, full rooms, RevPAR growth, positive headlines. But look at the right. That's the cold, hard financial reality. Net debt is actually growing, free cash flow is in the red, and, get this, auditors are literally issuing warnings that some of these companies might not be able to survive. So let's get forensic. We're going to break down the 4 hidden threats that are creating this crisis. And the first one is a massive ticking time bomb, the deferred debt dilemma.
This timeline here shows exactly how a short-term solution created a long-term nightmare. See, from 2020 to 2023, hotels got this lifeline. They could put a pause on their principal payments. But the interest wasn't just forgiven. No, it was capitalized, using something called PIKE, or payment in kind interest, which is just a fancy way of saying the unpaid interest gets tacked right back onto the loan. So the debt actually got bigger. And now we are barreling towards the year of reckoning in 2026, when these enormous balloon payments come due in a world with much, much higher interest rates.
But it's not just about the debt, not even close. Even with room rates going up, profits are getting absolutely crushed. Which brings us to our second threat, the brutal margin squeeze.
You see, rising revenues mean absolutely nothing when your costs are rising even faster. And as you can see here, the assault is coming from every direction. Energy costs are just eating up to 4% of margins. Food and beverage, which used to be a reliable profit center, is now a loss leader for a lot of places. And just look at insurance, spiking as much as 30% because of climate risk. These aren't temporary problems. These are new structural costs that are here to stay.
Okay, so the debt is growing and the margins are shrinking. What else could possibly go wrong? Well, there's a huge hidden liability that almost nobody is talking about, the capital expenditure backlog. We're talking years and years of deferred maintenance.
And this leads to a really dangerous new idea for investors, the brown discount. Simply put, hotels that put off those crucial energy-efficient upgrades are now being valued lower. Why? Because their future operating costs are going to be higher, and they can't charge the same premium rates as their modern green competition. They are literally getting discounted for being out of date.
And here's the real kicker. Delaying those renovations didn't just postpone the cost, it magnified it. The price tag to modernize these hotels today is now up to 40% higher than it was back in 2021.
And the final piece of this perfect storm is the people. Let's look at threat number 4, which is not some temporary shortage, but a permanent structural shift in the labor market.
So this new labor reality creates this really vicious cycle. First, all the experienced managers who left during the pandemic, they're not coming back. And that means operations are just less efficient. So to plug the gaps, hotels are forced to rely on expensive staffing agencies, which absolutely crushes their margins. The only real long-term fix is automation, but that requires a huge capital investment, capital that these debt-ridden companies just don't have.
This is exactly the kind of complex, multi-layered risk that gets totally missed by surface-level analysis. It's why if you're tracking the CSC or global hospitality, you'll want to stay subscribed to Ceylon Premier Analytics for these forensic deep dives. Seriously, understanding these hidden risks isn't just important, it's about survival. Now, let's make this real.
Let's see how all 4 of these threats come together in the real world. Because this isn't theoretical. We have a smoking gun, a case study that is the absolute canary in the coal mine for the entire sector. Just take a look at the financials for Browns Beach Hotels plc, which owns a 5-star property.
Their equity position is negative 750 million rupees. That means accumulated losses have wiped out every single cent of capital ever invested. Their net asset value is negative. Just think about that for a second. The company literally owes more than everything it owns combined. It's no surprise their own auditors have issued a going concern warning.
This is the one question that should be keeping investors up at night. How can a beautiful five-star hotel packed with tourists be worth less than zero on paper? The answer is debt, squeezed margins, and deferred investment.
You know, the story of Browns Beach Hotel is a verdict on what happens when you ignore the balance sheet. So how do you protect yourself? Let's walk through a quick forensic kit to help you spot the next one before it is way too late.
Your analysis really just comes down to 3 essential steps. First, free cash flow. Look past the vanity of revenue and see if there's any actual cash left after they pay to maintain their properties. Second, the debt profile. You need to know exactly when those balloon payments, that ticking time bomb, are set to explode. And third, real margins. Are costs actually growing faster than their room rates? This is what tells you if the whole business model is fundamentally broken.
And that leads us right to our final critical question. The collapse of Browns Beach Hotel isn't some isolated incident. It's a warning shot. These same pressures are building across the entire sector. So the only real question now is, who is next?